Good morning, guys. It is Thursday, April 25th, 2024. This is Bathrobe Business. I'm George Yoganov. I got coffee and I got the news. So, you haven't seen me in like almost a week and a half since last Tuesday was my last video because I've been traveling. That's where I got this amazing hat. So, I was in Peru all last week. I just flew back in yesterday afternoon. And I did promise a little bit of news, but when I came back, it's nothing to do with business. It's nothing to do with this channel, but it's for me personally. I got engaged in Peru. So after 36 years, I'm finally going to be married. So my mom is relieved. She doesn't watch this channel, but she is going to be relieved. And I got this amazing hat. I think this thing is just so cool. I got this in Peru. It's all alpaca too. So even though it's a lion, it's alpaca. Let's jump into the news. This thing doesn't want to stay up. There we go. That looks badass. Okay, so let's jump into the news. So this is going to be kind of short and sweet. I'm going to keep this video entirely about one subject today, and that is GDP growth. So you may have heard that GDP growth has slowed, or I guess came in underestimate, I should say. So GDP growth increased at a 1.6% rate in the first quarter, and that's less than expected. Economists, the Dow Jones economists that were surveyed were expecting a 2.4% gain following the 3.4% growth we got in the fourth quarter of 2023. Now, these numbers are actually better than expected. Why I say that is I'll explain it in a minute. I think if you actually delve into the numbers, the economy is actually doing real strong. Now, there are, as we've talked about on this channel, signals that the economy has weakness. As I've talked about before, I think inflation has been the underlying issue this whole time. Even though everyone's been saying that inflation is under control for the last year, it is not. And every time we're getting CPI numbers, I'm turning out to be correct, and that is why the Fed keeps pushing out cutting interest rates. And when we talked about supercore CPI, we see that it's been increasing. So when you're looking at supercore, it's actually increasing month to month on a trajectory up. So the underlying signals that inflation was always there is there, and that's with commodity prices, as I've talked about a lot. Gold had was steadily rising from 1,800 to 2,000 to 2,100, 2,200. It was at 2,400 before I left. It is down a little bit now. Again, I'm not one of those you need to buy gold to save yourself from inflation, et cetera, et cetera. I'm not Peter Schiff. All I'm saying is that gold actually is a powerful indicator. Usually that's one of the biggest indicators of inflation in an economy. And gold would actually be higher if it wasn't for crypto. If crypto did not exist, gold would be much higher than it is now. And when we talked about just before I left, Costco is now selling $200 million of gold a month. So there's definitely powerful inflation in the market. It's been underlying this whole time. It's been the silent killer, and it's still there. That's why interest rates are not going to be cut. But these numbers are actually better than expected. So consumer spending rose 2.5%, and that's the leading signal of growth in the economy, right? That's the main spear that grows GDP. So consumer spending is up. Business fixed investment is up 5.3%. Government spending, even, we shouldn't be too happy about that, but it did rise 1.2%. So where is the weakness in the economy happening? Well, it's not with layoffs and unemployment, because unemployment is down. It actually decreased last time we reported, and wages are now growing faster than inflation, more or less. If we go off of the hard numbers, wages are growing less than inflation. So overall, there's a lot of strength in that. Where a lot of this weakness is coming from is the first is a trade deficit. So the trade deficit probably shaved about 1 point of growth off of GDP. And that's not my made-up number. That's based off of an economist number. The wider trade deficit probably shaved about 0.9% off of the growth in the economy. Now, you could say, well, isn't there always a trade deficit? America almost always operates at it. It is. But there's only a finite number of resources in the economy, right? And when we reported a couple weeks ago that China's GDP was up, that exports were up, this is where the weakness is reciprocated in our economy. So as China exports more, we produce less. So a lot of it is the growth of Chinese products and the growth of the Chinese economy, and it's bearing on our economy. So that's the trade deficit. We're purchasing more than we're producing. That's where a lot of the trade deficit is coming from, where the trade deficit is contributing to low GDP growth. Now, another obvious sign is actually interest rates themselves. And inflation will play a role in here. Obviously, if products are more expensive, you're going to buy less. These numbers are supposed to be more or less adjusted for inflation, so I'm going to take that factor out, but there's obviously some inflationary pressure that you can't measure, and so that is playing a role in lower GDP growth, so we'll factor that in as well. But I think the trade deficit is a major one, and the second one is interest rates. Because interest rates are high, financing is going to be slowed, new acquisitions are going to be slowed, home purchases, home loans, home construction is going to be slowed. So that is kind of a bottleneck right now on the economy of what's preventing more GDP growth is the high interest rate. I don't think that's a bad thing. As I've talked about this channel, I'm a huge proponent of high interest rates because I think they actually create a lot of equality in the market. If you are interested, go back and look at my previous videos. Tune in tomorrow. I'll probably talk about it again. But interest rates are definitely playing a factor. And if interest rates were cut, the economy would skyrocket, get hot, and we'd face a crisis again. So this is another reason why I think that high interest rates are actually doing a really powerful role in the economy right now of keeping issues at bay. And I think they actually need to go higher in order to prevent a lot of the inflation that we are seeing. So overall, I would say GDP is actually very strong. It's just those two major factors that are playing into the effect. Consumer spending is up, business investment is up, government spending is up. So all the factors that would contribute to growth are still there. The economy is still growing and expanding. The biggest problem right now is inflation and trade deficits and interest rates. So that's why I think the numbers are actually really strong. I do not think that this is an underlying signal of a bad economy. Another good example is Southwest Airlines. This is just another story. I'm just mentioning it in passing. They had a really bad quarter. But part of the reason they had a bad quarter is because Boeing isn't meeting its production goals. So Southwest would be growing quicker, but they can't simply because they cannot get enough inventory quick enough. So this is another example of inefficiency in the economy that's preventing GDP growth. Had Boeing delivered on their products, Southwest would have higher earnings, more travel, more GDP growth. So there's these kind of silent killers in the economy where we have production issues that are preventing growth in the economy. So this is more of an output issue than a recession issue. So that's pretty much it. I think the economy is actually doing really strong with the exception of inflation, like I've said. That's pretty much all I'm going to talk about today. I do have to get to work. I'm playing a lot of catch up. I'll see you guys back here tomorrow. I hope you guys have a productive day.